If you're looking to buy a small business with an SBA loan, there are 3 financial due diligence items that I think you should really dive into before you make an offer on that small business. So before you write that letter of intent and provide that to the seller, I really think there are 3 things that you want to make sure that you look at first. So number 1 is, are there any major red flags in the seller's financials? Number 2, is the valuation of the business reasonable? And number 3, will the deal qualify for an SBA loan? So in this video, I'm going to be diving into how I analyze small business acquisitions using these kind of 3 key areas to focus on. I'll show you a spreadsheet I use and just kind of show you my process and my thought process here. In my background, I was an SBA lender for 12 years. I closed over 1,500 SBA loans during my time as a lender. Now I own ProjectionHub, where we help folks create financial projections, write business plans, and ultimately walk through the SBA loan process for startups and acquisitions and existing businesses. So one of the things that I enjoy doing, probably more than just about anything, is looking at acquisition deals and just giving feedback to folks about, here's kind of what I think about this deal. If it were me, how would I approach this? Would I feel comfortable with this purchase price or this deal structure, or whether this is a good business to buy? So I'm going to give you a little peek into kind of how I would think about looking at acquisitions deals in that pre-LOI due diligence phase. And so we're going to dive into that now. So the first thing you want to do is you're looking for red flags in the seller's financials. And so you'll need to gather the last 3 years of business tax returns from the seller. And you need tax returns because that's what the SBA lenders are going to be using to underwrite the deal. So I just suggest asking for those and looking at those. You can also ask for profit and loss from QuickBooks report as well. That can be helpful as well. But tax returns are kind of the gold standard in terms of underwriting. So once you have the financials, you want to get them into some sort of spreadsheet, and you want to put, each year in a column and kind of be able to see and notice those trends. Are the sales going up or down? Are expenses going up or down? And then you want to do some ratio analysis. So seeing the expenses as a percentage of revenue each year and seeing trends. Is cost of goods sold going up as a percentage of sales? That may indicate some problems. Or are net profit margins going up or down? You also want to be looking at how the seller's financials compare to industry standards. So you can pull industry data from tax return data. There's publicly available tax return data. We use a tool called BizMiner to pull some industry data reports and kind of see expenses as a percentage of revenue and be able to compare and kind of look at industry standards. You'll also really want to look at the add backs that the seller is putting into the deal. So they will often have, here's our tax return, but then here is an add back for $10,000, where what they're basically saying is that business is actually $10,000 more profitable because maybe I was expensing my personal car on the business. And so what I'm trying to tell you as a seller is, oh, actually, I was $10,000 more profitable. This expense it should be an add back. Or maybe I paid a family member as an employee, and really you won't need that family member, so we're going to add that back too. And so this process of add backs is trying to make the business look more profitable than it is on the tax return. And you're going to want to dig into those and see whether those add backs are reasonable. And the SBA lenders are going to look at that pretty closely too. Once you've done that, you're going to get what is called seller's discretionary earnings. And you need that seller's discretionary earnings, the SDE, as part of determining what a reasonable valuation is. And so we're going to look at how to value the business here next. So small businesses are typically valued at a multiple of earnings or seller's discretionary earnings. And so what I typically like to do as a starting point is use a site called BizBuySell. And so BizBuySell, it's a marketplace where you can list your business for sale. It's probably the biggest marketplace for listing small businesses for sale. And so because of that, it has a lot of data, and it has data on different industry sectors and what the average multiple is that those businesses end up selling for on the platform. And so I like to go there and just take a look, so you can find your industry. So let's say you're buying a nail salon, you can see earnings multiple 1.67. So you're saying that on average, these businesses are selling for 1.67 times earnings or seller's discretionary earnings. So if the earnings last year was 100,000, the sales price would be 167,000. That's how that would work. So the reason it's important to make sure that the valuation is reasonable based on a multiple of earnings is because if you're using an SBA loan, the SBA lender is going to be required to get an appraisal, a certified appraisal of the business. And similar to how you get a house appraised or valued when you're looking to buy a house and the mortgage lender requires that, and it needs to appraised for the right value in order to get that mortgage loan. You have a similar process here with using an SBA loan for an acquisition. And so if you have a situation where the purchase price or the proposed purchase price is just way above what the industry standard multiple is, it's probably not going to appraise and therefore probably not going to be able to get an SBA loan to finance that acquisition. Okay, so the last thing that I look at here in this pre-LOI due diligence process is I'm trying to determine whether I think this business is going to be able to qualify for an SBA loan. So in order to qualify for an SBA loan, it's going to have to be profitable in the previous year. Like that's kind of bare minimum. If it wasn't profitable, if the business wasn't profitable, it's going to be tough to value the business at anything more than kind of the liquidation value of the inventory or the equipment or that sort of thing. So if you're trying to value the business based on earnings, it has to have some earnings, right? So SBA lenders are going to determine how much of a loan you might be able to qualify for to borrow to acquire this business based on the cash flow of the business. And so the magic kind of term here is debt service coverage ratio. And the typical kind of rule of thumb is 1.25 or above. And so what that means is that you need to have $1.25 of earnings for every dollar of debt service. And so let's say based on the proposed loan amount that you're looking at, your annual payments for your loan are going to be $100,000. So you need to have $125,000 worth of earnings in order to support that $100,000 worth of debt service, right? So that's how the SBA lender is going to determine how much you can qualify for. They're going to back into kind of how much does this business qualify for in SBA loan financing based on that. Okay, so those are kind of the three highlights that I really focus on during my process. We actually offer a service here that we call the quality of earnings sniff test. You may have heard of a quality of earnings report. A quality of earnings report can be really expensive. It's almost like a mini audit. It's not really a full audit, but it gets almost a similar price to an audit, and you really dive into the details. Now, I think that's great if you want to do that, but when you're looking at a deal pre-LOI, like before you've even made an offer, you're not going to spend 20 grand on a quality of earnings report, but you might want to spend less than $1,000, maybe, $750 or something to do what we call our quality of earnings sniff test to get an idea of whether, how's the red flags, where are the red flags, what's the valuation look like, and will this qualify for SBA? So let me just show you the spreadsheet we use in our process. Even if you're doing this on your own, which I think hopefully through the video you can get an idea of how you could analyze this on your own, I think the spreadsheet could be helpful just to kind of show you my process. Okay, so this is just an example quality of earnings sniff test. Let's say we've got a business that they're looking to sell for $1 million. We're going to put in a 10% down payment of $100,000 at 10% interest on the SBA loan and a 10-year term. We add in the revenue from the last 3 years from the seller here. We do some basic projections, so you can just let's say you add a 3% annual growth rate to come up with some projected revenue going forward. And then on the expense side of things, you can see, as I mentioned, you want to get your expenses into some format where you can see year over year those trends and expenses and those expenses as a percentage of revenue. So in this example, you can see, oh, look, cost of goods sold from 2022 to 23 went up, but then it dropped back down. So maybe they fixed whatever problem was that was causing cost of goods sold to go up, right? You can see their net margin over time, and you might say, hey, why did that go up so much? It almost tripled here from less than 3% to over 9%. So I guess it more than tripled the year before they're looking to sell the business. So are there some things that they're maybe not expensing this year to try to increase the value of the business before they sell it? Could be something to take a look at. You're also able to kind of take a look at the industry standards. So this is where we look at the tax return data. So we get these expenses from tax return data and say, okay, let's compare the industry standard. Cost of goods sold is 44%, but our seller here is at 63%. So what gives? Let's dig into this a bit more. And then we get all of that financial, you can see the financial statement data here historically. And then this is where we add in all those add backs. So we can say, oh, the seller made a donation every year to this charity. We're probably not going to do that. So this will be an add back. Oh, the seller had a holiday party that they paid for out of the business. Maybe we won't do that. So that can be an add back. So there's lots of different things here. You can add back owner's compensation here as well. Well, ultimately, again, trying to get to this adjusted seller's discretionary earnings number here. And then in this case, we took the average, the 3-year average of that SDE, applied an industry earnings multiple from Biz Buy Sell. So we said it's an electrical and mechanical contracting business. So taking that 2.55 multiple times that SDE gives us this adjusted valuation of $636,000. So that's what we think it might be worth based on SDE and industry multiples. But hey, maybe this client thinks they want to sell the business for $1 million. Okay, well then we need to see whether it can actually cash flow $1 million purchase price. And so when we're thinking about, this is kind of the final bit of the process here, we're thinking about an SBA loan for an acquisition. We're going to say, well, first of all, you should have some working capital. So we typically say 1 month of operating expenses, and this can vary depending on the business, but let's say at least a month of operating expenses, and then the business purchase price of $1 million and some closing costs for the lender gives you a total cash need of $1.15 million. You've got buyer cash down payment of $100,000. This leaves you with, $1,059,000 in debt that you need. Now maybe you have a seller note, but let's just say we're doing this all with an SBA loan at 10% over a 120-month term. So it all comes down to our debt service coverage ratio here. We can see in this first year, it's projected to be 1.43 based on our $240,000 of cash from operations, our net income, divided by our debt service of $168,000. Now, this is projected. So we projected an increased sales by 3%. We maybe got rid of some expenses. Now, what if we said, well, this business actually, if we come back here, so this business actually only did $143,000 of net income last year. So let's just change this because the lender is going to look at this and say, how much did they actually do? Well, they actually did $143,000 of net income last year, and we're saying debt service is 168. Our debt service coverage ratio is less than 1. You can't even cover the debt service with that cash flow, right? So that's not going to fly. And so now your process is to go back to the sales price and say, okay, it can't work at $1 million, but maybe it could work at $750,000. So let's change our purchase price here. Okay, that improved us a little bit. Now we're at 1.11. Maybe we can go back to that 650,000. We're just over the 1.25. So now we're at 1.27. So anyway, that's the process that we would be going through in that quality of earnings SIF test. We'll put a link in the description of the video below to learn more about that service if you think that would be helpful. But this is the process and really the steps that I think you should go through and think through as a potential buyer of a small business, especially if you are looking to get an SBA loan to help you do that. So hope that's been helpful. If you have any questions, please feel free to reach out. You can reach us at support@ProjectionHub.com. And if you found this video to be helpful, it would be awesome if you liked the video and subscribe to our YouTube channel. That would help us out a lot. Thanks.